Welcome, and thank you for joining DMA's first digitised event, Access to Capital Africa. I want to thank Atam, Katie, and the rest of the team at DMA for conceiving this event. It's been based on many conversations during lockdown, which identified access to funds as one of the real challenges on the continent. It's a credit to the team that an event based around different funding streams, some traditional, some less so, is a conversation worth having right now. In the first instance, however, I hope you are all safe and have managed to salvage some positives from these past few months. My name is Adil Kurt-Elli. I'm an investor, a founder, and an advisor. I launched aldersmead earlier this year to support public and private sector clients. Aldersmead helps develop innovative solutions across the capital space with a particular focus on developing markets. Outside of Aldersmead, I'm also working with a number of early stage entrepreneurs, helping them on the path to success with their various projects. Today, I have the honour of chairing DMA's inaugural digital event. I've had the pleasure of knowing DMA for some time. DMA is widely accepted as one of the world's leading trade and investment promotion bodies in the emerging market space, and indeed, many of our collective first experiences of emerging markets may well have actually begun at a DMA event. Having hosted over 300 heads of state, government and cabinet ministers physically in London, today's event actually marks the beginning of a new type of online engagement for DMA. They've been beta testing various platforms over the past few months and have chosen one you're on today for efficiency, effectiveness, and the ability to work in markets with low internet bandwidth. Now, a little bit of housekeeping. If you have any questions at any point during the session, please do submit them via the Q&A box below, and we'll field as many of them as possible during the discussion session. If you have any issues, please do send an email to events@developingmarkets.com, and we'll be monitoring that too. As with all DMA events, all of the information you view will be online at developingmarkets.com in about a week or so, and will remain free to use as always. So, thank you for joining us today. We're delighted to have as many of you as have dialed in, and with quite the range of amazing profiles that you all represent. We also want to extend many thanks to the Wall Street Journal for promoting this event and for all of our speakers. So it's now my pleasure to introduce our opening speaker, James Duddridge, MP, Parliamentary Under Secretary for Africa. This is an interesting time to learn about both the FCO and DfID, I think you will agree.
Good morning. As the UK's Minister for Africa, you'd rightly expect for me to enthuse about the continent and specifically the UK relationship with African countries. But for me, this is more than just a job, a role, a position in government. Africa holds a personal importance to me. It's been at the heart of my professional and personal life. It's where I met my wife and where I cut my teeth in finance, working across what's now Eswatini, Botswana and the Ivory Coast. For these reasons, the continent remains close to my heart. And I want it to succeed, and I believe it will, it can. Before I get into the specific question on access to capital, I'd just like to flag that the COVID health and humanitarian response is, of course, a key priority to the UK. The UK is leading international efforts to develop a vaccine. We're the biggest donor to the Coalition for Epidemic Preparedness and Innovations. Thanks to this investment, future vaccines will be made available at the lowest possible price, not only to the NHS, but to healthcare systems around the world, including in Africa. I learned so much during my time working in Africa, but if there's one key thing I take away that brought it home to me, it was that Africa is the place of immeasurable wealth. The continent is diverse, and the country's wealth comes in many forms: natural resources, innovation, creativity, and humanity. That's why I was so thrilled to see the commitments at this year's Africa Investment Summit to better harness this wealth and drive forward economic progress. It's clear the impact of COVID has hit African financial markets hard, some countries more than others, but with impacts across the board. Credit ratings have had to be revised down, and African borrowers are facing significant challenges accessing finance on reasonable terms. The economic disruption and financial volatility caused by COVID have hit developing economies severely, putting at risk decades of positive economic development. That's why we're working with partners to ensure firms and consumers across Africa are supported to respond to the disruption to the financial markets. I want to touch on a few examples of what we're doing. CDC, the UK's development finance institution, is working hard to support their portfolio of 690 companies across the continent. At a time when other commercial investors are retreating from some markets, CDC has stepped up to bring liquidity to the market and promote investment that can scale up access to healthcare and basic services. We're also one of the largest shareholders of the International Finance Corporation, which is loaning more than $850 million in new working capital to SMEs in developing countries as part of an $8 billion COVID response package. In addition to this, we continue to work to deepen financial markets across the continent and make them more resilient. As one of the world's leading financial markets, the UK has a key role to play in working with partners in Africa to make sure the financial system works to everybody's benefit. The reliance of many African borrowers on international currencies leaves them vulnerable to exchange fluctuations, so we're committed to increase access to local currency finance. Through the financial sector deepening Africa, we are investing in local currency bonds, the Africa Local Currency Bond, which has now invested more than $150 million over the last 5 years across 14 different African currencies. We're also an investor in the Currency Exchange Fund, which is providing hedging solutions to support investment in local currencies in sectors such as SME lending, infrastructure, housing, renewable energy and also agriculture. In January, the UK government hosted the UK Africa Investment Summit. We laid the foundations for partnership between the UK and African nations based on trade, investment and mutual interest. We welcomed the first ever Kenyan shilling green bonds to the London Stock Exchange, and we announced billions of pounds of new commercial deals. These partnerships between the private and public sector, which work for the mutual benefit of the UK and African countries, are exactly what we need to see more of. They're partnerships that can support Africa's recovery and prosperity, unlock its growth and deliver the transformational change that the continent needs to release its full potential. And as we continue to fight the spread of this global pandemic, we must continue our collective efforts to stimulate the capital markets. And we must do this in a way that supports a green and sustainable recovery. All of us have a role to play in Africa's brighter future. And this forum is a great opportunity to connect and share ideas. I look forward to hearing about the outcomes of today's discussions. Thank you.
Thank you to the Honourable James Duddridge MP, Parliamentary Under Secretary of State for Africa, for his thoughtful and supportive opening remarks. This session on access to capital benefits from an esteemed panel of speakers who will provide you with an insight into a diverse range of capital raising solutions before engaging in a question and answer session with you, our audience. I will start with a short introductory presentation to set the scene for today's discussion. Capital raising is a relatively simple concept covered in a huge amount of complexity. You see, it's a series of contradictions. Depending on your perspectives, it can be easy or challenging. Think about the first-time borrower versus a frequent issuer and their relative experiences in gaining traction with the investor community. It can also be expensive or cheap. Maybe this is about relative value of local currency versus foreign currency benchmark rates. But consider also that it's not uncommon to encounter high-frequency borrowers concerned about saving 5 basis points of fees on a 10-year transaction, whilst not really considering the potential of a 10 basis point increase in interest rates running on the debt due to poor execution. It can also be viewed as highly efficient or not. So let's not really get bogged down in the minefields of transaction structuring, but I think you get the gist. In introducing this topic, I risk the accusation of talking in broad terms and making generalizations, whilst, as you know, the truth is every capital raise is unique. But then again, maybe it's not. You see, it's possibly another contradiction. In this short session, I'll outline a series of simple steps you can use to reduce complexity and increase success in a capital raise, regardless of the economic backdrop or the format of the raise. You might then consider these suggestions as each of my co-speakers gives their insights from their different experiences. Whilst the last crisis saw capital flight, today you'll learn of an unchanging appetite from a sovereign government independent of the pandemic. You'll also hear about an increasingly sophisticated and diverse number of instruments available to invest in business in Africa, from high net worth individuals and collectives in the diaspora. And you'll also hear about private equity still looking intently for new opportunities. So let's go back to the contradictions for a moment. The first half of 2020 could be considered a contradiction. In the first quarter, panic reverberated through the markets, with investors unsure of the economic impact of COVID-19. This uncertainty, coupled with general perception of market overvaluation, resulted in a sell-off wiping trillions of dollars off the stocks globally. We all stared into the abyss. The knee-jerk response was for everyone to assume the markets were shut. And to an extent, observers were right, because whether it was pandemic or some other significant event, the general view was that the market was overdue some form of correction. And so the markets did shut, sort of, unless you're a high-frequency borrower in the bond markets, or perhaps a couple of weeks later, you happen to be a reasonably well-regarded high-yield issuer. And perhaps, of course, you might look at the situation a couple of weeks thereafter, when an established mid-market upstream oil and gas company was able to raise funding. You see, the markets have become increasingly dislocated from reality. And this is due to excess liquidity on the back of various sovereign-led stimulus packages, be it quantitative easing, central bank rate cuts, the government guarantee schemes. This means that even in high-impact events, such as a global pandemic and a series of lockdowns, there's still significant cash that needs to be put to work. So fast forward to the end of the second quarter, with equity markets showing little of the signs of distress that we witnessed in March, and a vibrant bond market is still taking advantage of ultra-low benchmark rates. And yet, any half-hearted analysis of the fundamentals, and by that I do mean a grassroots approach to how economies work, as opposed to following the sentiment of Tesla stock on the Twitter feed, you should be able to assess that the markets are significantly overvalued and default rates will increase once the various government-led support packages are unwound. Unfortunately, unemployment is likely to rise. Consumption is likely to fall after the initial post-lockdown surges that we're witnessing. Corporate earnings, therefore, will suffer, and as a result, markets will look to sell off again. So why does this matter if I'm trying to raise finance for a social housing project somewhere on the continent of Africa? Well, that's because the likely source of capital for the project is going to be a combination of local and international or multilateral funding. And if any one of those jigsaw pieces is missing, that project itself might not get off the ground. So the question is there a secret source to this? Well, spoiler alert, there isn't. The true secret to successful capital raising is some pretty basic psychology. It's all about what we call self-awareness, the basic identification of who you are in the context of your potential investors. Whether you're a first-time fundraiser or a large high-frequency borrower, this is the single most important rule. So why is it important? Well, if you know your place within a market, you will know who you need to match up with in order to obtain the funding that you need. As I said before, capital raising is simple. One side, you have someone who needs funding. And on the other side, there's a whole community of professional investors who have to put money to work. The trick is identifying which investors are the right ones for you, given who you are. Spoiler number 2, this is not about who you want to be. That comes later. So what's the easiest route to self-awareness? I would suggest there are 3 high-level but interrelated areas that will get you a long way down the track. The rest follows from these 3. Timing is important, but as with all things, this has many interpretations. Timing can refer to the stage of your business or project. Are you an established player in the market? Do you have existing creditor relationships? Are you early stage, pre-revenue? Is your project pre or post-final investment decision? This will help you understand if you should go to a debt or an equity provider, or indeed a combination of the 2. It will also help you consider the relationship that you're looking to have with the counterparty as you grow. Timing also requires you to look around and consider the timing of external factors relative to your own situation. For instance, as we're witnessing, a pandemic could be relevant, but so too can a market rally, and you have to be open to this. In developing markets, a common timing factor is often political event risk, such as an election or upcoming IMF review. So this now ties us into location. Unlike established markets, the developing markets have access to a smaller, more specialist pool of liquidity across both debt and equity. Within this dedicated investor community, there will be limitations in the geographic mandate, usually driven by a number of factors that include but are not limited to familiarity with the country, market liquidity within the investor community peer group, internal, external ratings, and political stability. It's important to quickly identify which potential sources of capital are active and have funds available to deploy in your location. Otherwise, you're wasting time, and we've already established that time is a factor. The format of your raise is also important. Debt and equity are actually very broad terms. Contained within them are a number of subsegments and subproducts. Aside from the traditional product, there is a range of instruments such as debt that have equity-like features and vice versa. Knowing which one to use and when is vital. Each type of capital will be more or less appropriate to the specific situation you're considering. It's important to keep an eye on those implications further down the line for your business. Although capital raises ultimately are about getting the cash, the terms of that investment or loan can potentially create hurdles in the future, whether that be additional capital raises or flexibility to undertake early redemptions or refinancings. Take the example of a project refinancing I worked on. The initial project itself was structured with long-term loans and multilateral support. For all the right reasons, the original structure dictated that interest rates were hedged for a significant portion of that debt. Following a period of project operation post-completion, the project sought to refinance into the bond markets, so the interest rate hedging was no longer required. However, the hedge was now also out of the money, so the break costs would actually bankrupt the project. What was originally a great structure at the outset was no longer fit for purpose, and indeed it could be a hurdle to the future growth and refinancing of this business. We did actually manage to solve for that on the day. It wasn't simple, it cost time, but it also needed a lot of compromise. On the plus side, we did actually learn from that experience and have developed alternative structures when looking at initial project financing. So I guess you could say that, there's a positive, we've all learned. So how does this all come together in practice? Well, as I said at the outset, capital raising is actually quite simple at its base level. If you can be self-aware, you're halfway to finding the right counterparty. A good advisor will then be able to match you to the right investor base. That community will be looking to deploy capital specifically to your situation, taking into account 3 core considerations as we've highlighted already. Once found, the right investor will then be incentivized to provide you with the most appropriate terms for your financing, giving you the best platform to achieve success and ultimately to give them the return that they're looking for. With this in mind, I would now hand over to my co-speakers who will give you some insights into how they're looking at capital raising. It's now my pleasure to introduce Jabir Sardharwalla of SkyBound Capital.
Well, good afternoon, everyone. My name is Jabir Sardharwalla. I am Chief Strategist for SkyBound Capital Limited. I've been with them for about 8.5 years, 9 this coming November. And my function is quite varied. First and foremost, I continue to monitor macro and political developments around the globe to see what ultimately what impact it will have on markets. In addition, my role is to source new investment opportunities, as well as sit on investment committees and monitor risk. But last and not least, to help develop with the business development side of life, which is a very wide remit, particularly given what we do. And what we do is quite niche, as you'll discover in a second. SkyBound Capital has been going since 2007. It's been in the private debt lending space for many, many years. It was actually in that sector even when I joined in 2011. And we had then, and we still have today, a dedicated private lending vehicle, which at that time was 100% focused on Africa. And it was incredibly specific. It was lending to two specialist counterparties whom we seeded from the very early days. And their role was to help provide loans to government employees in a total of 5 African countries. And those countries to this day are the same. They are Kenya, Tanzania, Uganda, Ghana, and Zambia. We as a company have our main office in Cape Town, South Africa. So we really know the African landscape. I'm based in the London office. And today, that same fund is in excess of $500 million. It's not pure 100% African focus, and that's only because it has globally diversified. But we still remain avid fans of the African landscape, and the new initiatives underway will now see that portion increase again. We today manage around $2 billion in assets, both directly and indirectly. And by that, I mean direct investments that we've gone into, as well as investments where we've taken a strategic stake, and they themselves, their underlying assets, are quite considerable. So why do we like private capital, especially private debt? Well, if you look at some of the statistics here, they're actually quite startling, and I would even say shameful in terms of what ends up in Africa. So, for instance, I'm quoting some stats now from the Prequin report for 2018, and 2019 is not that much different. The total private debt AUM was around $800 billion, so quite sizable, not far off 1 trillion. Today, those same vehicles are sitting on dry powder, i.e. cash waiting to be deployed in the order of just over 300 billion. So, at a time when we need new capital, there's a huge amount just sitting in cash waiting to be deployed. Obviously, COVID has had a big impact here because people have become nervous. And there are a total of 1,764 funds trying to operate in this space. Now, if you look at specifically in 2018, new funds raised totaled about $110 billion. So that's for the whole year. Of that, direct lending accounts for over 40%. It's around 44, 45%. The North America takes up the largest share at around 62%, with Europe at 33%. So you can see where the lion's share of the allocation in private lending is going. I would call it the usual suspects. Asia and the rest of the world accounts for the balance, which is about 4%. And when you break those two down, Asia is $4.3 billion out of the $110 billion raised. So that leaves $0.6 billion for the rest of the world, which includes Africa, but not just Africa. So you can see how so little is ending up in Africa. And for such a vast landmass, with one of the fastest growing population rates. And then there are some further stats which are really quite alarming. So, for instance, Riskura did a study on this, and they looked at the total number of unlisted companies in Africa and how they raised their total capital. And only 1/3 comes through debt. In the developed world, by comparison, it's 2/3. OPIC did another study to see how easily debt is accessible to the African population, and they found that less than 3% of the African population has access to debt. Now, you contrast that with 24.5% in the developed markets, and in the high-income countries, it reaches a staggering 18%. So capital is simply not getting to where it's needed. So this is one of the other really big opportunity sets for us. Furthermore, if you look at the returns, and particularly in an era where the global macroeconomic picture is one of incredibly low interest rates, it was before COVID, it's now going to be just as low, if not lower, during and post-COVID. In an environment where volatility is very high and where people are incredibly nervous about where to allocate, and fixed income in the liquid markets has become really a very precarious sector. Just look at the returns in the private debt space as a whole. It's in the region of 8 to 14%. 8 to 14%. And if you look at one of the biggest sub-segment, that's private lending, it's around 8 to 12%. These are phenomenal returns. Now, for any portfolio asset manager, the ultimate dilemma is how do you achieve non-correlated returns? I've been on many roadshows and spoken to many blue chip names here in the UK and also outside, but primarily in the UK. And their biggest headache is that when they look at the traditional bond equity mix, the bond portfolio is simply not giving them the protection that they would like. And yet they are obliged, based on these antiquated models, to allocate certain allocations to these sectors. They look at our returns of our private lending fund, and they see in its 11-year history, bearing in mind that SkyBound launched in 2007, they see in its 11-year history that the fund has delivered 7 to 8%, not just annualized, but every year in US dollar terms, a little bit less in euro and sterling terms because of the hedging cost. There is no leverage. It is fully diversified. The asset security and collateralization is enormous. These are emerging bonds, which effectively have a minimum single B type of rating. We've never had a full credit rating done. So in an environment where people are really scratching their heads wondering, should I still allocate to high yield given the current environment? And how much energy is there left in investment grade? This really is the alternative sector to consider now. And as we have been doing recently, we've combined, purely for inflation protection, a little bit of equity upside, so what we call hybrid structures, where principally we're still collecting interest, but we're also getting a little bit of equity upside in what we do. And that can take the returns up to 12 to 14, even 15% on an annualized basis. So what are the issues? Why aren't these lenders allocating, particularly when they drill down to Africa? Well, first of all, size does matter. Size really is an issue. The 110 billion that I spoke about in terms of new funds raised in 2018, the 800 billion that I spoke about, the total AUM in 2018, it's dominated by the big players. They can raise funds in the order of 5, 6, 7 billion and above. And then they have the single biggest headache is how do they allocate? Because we like to operate in that niche space, which focuses in the same area that nobody wants to go. It's the lifeblood of an economy, of the world in general, and that's the small to micro cap company. Those are the guys who are getting off the ground, who are most vulnerable, and they need guidance, and especially they need capital. We really have got the guts to go there because we have now come used to that sort of culture. They will not go there. Even if they did, they wouldn't know how much to allocate. They would lose it on their balance sheets, given the amounts of money that they raised. The second thing is many of them still have a phobia about Africa. They just don't get it. If I was to draw a series of concentric circles coming out of Africa, obviously you have African allocators. But even amongst them, the banks, for instance, are very shy and lazy to allocate because for them, the easiest place to allocate to are the governments. They can get the same sort of returns for less risk, or at least the same risk. It's easy money. But the minute they have to step out, it becomes complicated for them. It's too much work. Then when you go further afield to a circle that encompasses, let's say, the Middle East and Europe, there's more understanding because obviously there's more collaboration. And on the eastern side of the world, I would include Asia, that even then they have the issue of size and they still don't understand the culture. They don't have the context. They don't have the networks. And then last but not least, when you draw a circle that spans, let's say, the US, North America, I'm afraid the level of understanding really does drop. You then have to start getting into the specialist allocators, whether it's the World Banks, the IMFs, the very high wealthy family offices who have endowment funds and who are really dedicated to sectors such as Africa. Last but not least, there's the network. To operate in Africa, you have to know how to do business. And for that, you have to have a series of contacts. You have to know who to be able to call up. You have to know how to get to the areas that matter the most. This is all hard work for people who are not acclimatized with Africa. And so they prefer to take the easy option and just sit back. These are some of the fundamental problems that Africa faces. And yet the opportunity that it offers, especially in a COVID environment, is just enormous. So that general small to micro cap space is really, as I said earlier, the lifeblood of any economy. When you look at employment statistics, whether it's in the world of developed markets or emerging markets, you will easily find that 60 to 80% of all employment is accounted for in that micro, small, mid-cap sector. That's why governments are so hell-bent right now in making sure that businesses don't fall off a cliff. It's why Rishi Sunak over here is offering eat-out vouchers for the month of August. It's to encourage people to go back. Otherwise, we're going to lose our little businesses. So can you imagine what Africa's going through? So in conclusion, what I would say is this. SkyBound at its heart is an African operation. Even though we've moved our investment headquarters to London, we've done that purely because it's easier to centralize on GMT time zones. But our presence on the ground will always be in Africa. That's where we have the teams. That's where we have the due diligence teams. That's where we have the networks. One of the initiatives that we have, for instance, now because of COVID and because of our passion and affinity for particularly South Africa, being that we are a South African company, is that COVID has destroyed so many small and micro cap businesses. We are on the verge of launching a business rescue fund, which is aimed at helping businesses in the tourism sector, in the hoteling space, in the travel industry. Otherwise, these businesses are going to go to the wall. For that, some of the expertise that we are lining up with are bankruptcy specialists who say it's just heartbreaking to see the kind of companies that they're having to deal with. Secondly, we have the network, and it's substantial across private debt players, private equity players, specialists in sectors like technology, information systems. It's significant. Not many people have access to this kind of network. And therefore, with it comes a good pipeline of deals. If we sometimes we ask ourselves, how far could we grow our existing fund alone? And just with our existing relationships, we could double the capacity from over 500 million to 1 billion, just topping up the existing investments that we have. That's how much capital they are crying out for. That's not even taking into account the new investment opportunities that the same counterparties have. For instance, in Kenya, the partner we have would love to get into the mortgage sector, particularly providing deposit finance. So that's a whole new area that potentially could come off one day. I mentioned the new Business Rescue Fund. We would love to do that further afield. And if it can come with government support, that would be fabulous. COVID has really provided a whole new opportunity, which for us, we would love to deploy and participate in. And last but not least, we are a niche player. We always have been. We're not afraid of it. That's our culture. As I said, I joined in 2011. SkyBound was launched in 2007. And the owner of the business, Cliff Warren, ran a previous company on very similar lines. So actually, there's a continuous track record here. We are not afraid to go in at the small end. We know that our liquidity will come from the bigger players above us, the larger funds that I alluded to earlier, the $5, $6, $7 billion funds. That's where our opportunity to exit one day will be. So that's us in a nutshell. That's SkyBound. It's what we do. It will never change. We are now a global player. We don't just operate in Africa, but Africa is still a significant part of our book, some 20%, and it will start to rise again. And in order to allocate to new projects, we need capital. I'm not ashamed to say it. That is our situation. And we would love to collaborate with people who would love to get into the African space, but don't themselves have the know-how and would like to partner with an entity like ourselves, perhaps, who does have the expertise in this area, who does have the network, who does have a natural affinity and culture for this sector, and deploy additional capital. So thank you very much for listening to me.
Thank you, Jabir, for such an interesting insight into the private investor approach to capital investment. To offer a different perspective, I'm now delighted to pass across to Carla Senatore from UK Export Finance.
Hi, everyone. It's a pleasure to be part of this event today and have the opportunity to introduce the work of UK Export Finance. Just by way of introduction, my name is Carla Senatore. I sit in the Business Origination Division at UK Export Finance. So UK Export Finance is the official export credit agency of the United Kingdom. We were also the very first export credit agency ever created. We were founded in the 1919, right after the First World Conflict, with the objective at the time to help the economic recovery of the country. And this means that now we have over 100 years experience in doing what we do, which is to support UK exports. We sit within the Department for International Trade, and we sit in the Treasury building. And in fact, we work very closely with those two departments, with colleagues from those two departments. But we do also work very closely with the private sector, and particularly we work very closely with insurance firms and with banks with which we share the risk on export transactions. Our official mission is to make sure that no viable UK export fails because of lack of finance or insurance available from the private sector. And this statement really highlights how our job is really to complement the offer from the private sector, not to compete with it. We offer a broad range of different insurance and financing schemes designed to facilitate export transactions, and I will touch on those schemes shortly in more details. We can support exports, all type of exports really. We can support exports of goods, exports of services, but also exports of intangible assets, such as intellectual property rights, for example, or software licenses. We can, of course, support UK companies of all sizes. We can support SMEs as well as large corporations. And we can do business in over 200 markets all around the world. And actually, if you visit our website, you can see the exact list of markets we are on cover for at the moment, and also the exact budget allocation or risk appetite we have for each market. When we provide buyer finance, meaning when we provide financial support to the overseas clients of UK companies, we can do so in many different currencies. We can do so in over 60 currencies. And again, if you visit our website and you're interested in a specific region, it will be displayed on the website whether we can offer local currency financing in that market or not. Just to give you a flavor of what we achieved last year, we provided over 4 billion worth of support to many companies, 339 to be precise, helping them export to over 60 different markets. And you might be interested in knowing that the majority of those companies were SMEs. So looking at our products in more details, essentially our range of financing and insurance facilities are designed to help UK companies throughout all the different stages of a potential export transaction. So some of our schemes are designed to help companies at the very beginning when they are looking to win contracts overseas, and they might come to us to see their chances to win those contracts enhanced by our ability to offer their clients competitive finance. We do also have schemes that help companies at a later stage when they have already won or one or more contracts, and they need the extra cash to be able to fulfill those orders. And finally, we also have insurance schemes that are designed to help companies make sure that they do get paid at the end of an export transaction. So when it comes to helping companies, UK companies win contracts overseas, as I mentioned, we do so through offering competitive financing terms to their clients. And when I say competitive terms, what I mean is lower favorable interest rates, essentially, and longer than usual repayment tenors. The most traditional way to which we provide our support to overseas buyers of UK goods and services is via issuing a payment guarantee to the lending bank. And our guarantee essentially has the power to mitigate the risk in the transaction so that the bank will be able to charge more, to price the loan at more favorable rates. As I said, with our support, the bank will also be able to, the transaction, that the buyer will be able to benefit from longer repayment tenors. Our tenors can go up to 10 years, and in some cases, for some sectors, for example, renewable energy, projects in the renewable energy space, our tenors can go even beyond the 10 years. They can go even up to 18 years. I said that the most traditional way through which we provide support is via a guarantee, but we do also have a direct lending scheme. And in this case, as the name suggests, we will act as a lender directly. And the money to support the transaction will come from the Treasury rather than from a bank. But we will still need a bank to act as an agent for this type of transactions. A second line of products we provide are those designed to help UK companies raise the extra finance needed to either satisfy working capital requirements or satisfy bonds requests under export contracts. So we can, with our working capital support scheme, we can guarantee up to 80% of the value of a working capital loan. And with our bond support scheme, we can cover for up to 80% of the value of a bond, thus helping UK companies access the funds needed to take on contracts overseas without facing constraints to their cash flows. Last but not least, we offer credit insurance policies, and our export insurance policy is designed to protect companies against the risk of payment default from the buyer, and it covers for up to 90% of the value of the export contract. We do also offer a bond insurance scheme, which protects companies against the risk of having to pay in the event that a bond is called upon for unfair reasons. And then it is also worth to mention our overseas investment insurance scheme, which is the only product we provide on the equity side, and is designed to protect UK investors from political risk when they invest overseas. So what types sorts of criteria or requirements we need to see met for us to be able to consider offering our financial support to companies? Well, first of all, we do need to see an export. So we need to see an export contract. We need to see a UK-based company entering into a contract agreement for the supply of goods or services to an overseas entity. We do also need to see 20% UK content at least in any project we are asked to finance. And provided that we see 20% at least UK content, when it comes to buyer finance, we can normally provide support for up to 85% of the project value. And then, of course, we will also be quite strict on the due diligence conducted on any environmental, social, human rights impact that a project may have in a community. And we will also make sure that, check and make sure that the project we are supporting and the parties involved are not somehow breaching any legislation with regards to anti-bribery and corruption rules. On this slide, you can see just a selection of projects we supported all around the world and across different sectors. We provided bond and working capital support for Solar Century recently for a combined amount of £47.6 billion. And this was to help the company build 2 large solar plants in Spain. We provided buyer finance support to Metrobus in Mexico to allow them procure 90 low-emission buses from Scottish company Alexander Dennis. We are financing the building of rural bridges in Sri Lanka, and in this case, the UK company that benefited of our support was the Cleveland Bridge. We helped a Nottingham-based company to export fertilizers in Ukraine a couple of years ago when the political climate atmosphere in the country was perceived as very risky, and the company couldn't find any export insurance in the private sector. They came to us for help. In Africa, we are financing the construction of 3 new hospitals, supporting a contract between the British arm of Al-Shafar Group, the big construction group, and the Ministry of Health in Angola. And the level of support is worth 380 million euros. And again, in Africa, in Uganda, we are financing the construction of a new airport in Kabali. And in this case, we used direct lending for a total amount of 270 million euros. So as you can see, we are very happy to finance projects where there is involvement of UK companies. And we can support projects in any sector, really. And we would be very happy to hear from you if you have any project ideas you would like to discuss. We have a team of export finance managers based throughout the UK that can provide early stage advice for your projects. And we do also have a network of international representatives that are based in strategic markets overseas and that can help you with your project inquiries. Their details are available on our websites, and so do please feel free to get in touch if you have any questions. Thank you.
Thank you, Carla, for delivering such a thorough discussion on the important role of UK export finance. And so now I'm pleased to hand across to Eric Guichard, founder and CEO of Homestrings, who will have some truly interesting insights into alternative sources of liquidity.
Hi, my name is Eric Guichard. I'm CEO of Homestrings, a diaspora engagement platform that I founded in 2011. I've been asked to talk about the diaspora angle of capital access, particularly in the context of COVID, and what we're seeing and what are the tools that we have seen evolve since we began getting involved in formalizing diaspora investment into their home country. Since we launched our own crowdfunding platform in 2012, we've seen significant growth in the number of initiatives, not only in the West, but also in country. For example, we advise the government of Morocco on legislation around crowdfunding so that they can launch their own ecosystem in Morocco to facilitate not only domestic investments, but also international investment coming from the diaspora and others into their crowdfunding platform. And then, there's been an explosion, obviously, of web-based solutions looking at VC as well as private equity. Notable examples would be CairoAngels.com, a very successful platform with two ecosystems, an ecosystem of diasporans living abroad and then an ecosystem within Egypt to source transactions. Both ecosystems are connected and self-feeding. In some cases, the same people working on either side of that ecosystem. And then there's crowdfunding in of itself within sub-Saharan Africa with the African Crowdfunding Association and other similar initiatives. And then obviously the growing ecosystem around venture capital in of itself. We've seen a growing number of financial products targeted at SMEs, targeted at property that are initially offered by banks in association with their deposits, and then increasingly offered directly as listed products, as well as privately placed products. Clearly COVID has put somewhat of a slowdown on investments into SMEs or investments from the diaspora because of the uncertainty around the lockdown. Some of that is dissipating, as we see in Europe and in some other countries. But clearly we don't know what the COVID situation is going to be with respect to job and income producing opportunities for the diaspora, and in turn, their ability to use this, discretionary income for investment purposes. Similarly, we don't know what the landscape is going to be in terms of deal sourcing, deal vetting, and the rest. Those are still unknowns, and so we're still waiting to figure that out. However, we're seeing a lot of deals within the VC space. We're participating in a lot of deals within the VC space, in part because the gap is being created by COVID, and valuations have come down, and so we're looking to participate both in my individual personal account, but also on behalf of client of ours. I think that diaspora capital is here to stay, whatever form it takes in the post-COVID world. The savings are quite significant. I think the World Bank estimated at somewhere around $30 billion among diasporans from sub-Saharan Africa. And then savings in pools of capital within the continent. When you look at remittance transfers from countries within the continent to other countries within the continent, those are significant. In some cases, completely outstrip incoming flows from the West. And I think there are significant opportunities there to capture intra-diaspora capital. So on that note, I'm looking forward to the discussion as I sit here in my lockdown abode. Thank you, and I look forward to your questions.
Eric, thank you for sharing this new approach to capital raising solutions. And so now we move on to the audience interactive discussion. for which we will be fielding as many questions as possible from those that have been coming through during the course of the session.